in honor of 300 subscribers, I would just like to say about this Motley Fool article slamming Medical Properties Trust. This is blasphemy. This is madness. Madness? Yes, madness, ladies and gentlemen. Okay? So, more than just, to the point about Medical Properties Trust in particular, this is, in my view, a case in point of why you should not necessarily trust what somebody has written in some random article for these sites, Motley Fool, Seeking Alpha, what have you, okay? There are some articles that have interesting information that maybe you can learn and take away. Maybe they have some type of fact or bit of information that maybe you didn't have. So it's not necessarily worthless to read them, but I would take any suggestions or recommendations or conclusions they draw with a grain of salt, not at face value. Now, the reason why, okay, they're saying MPW's track record as an investment is completely and utterly brutal. Now, that may be overstating things just a little bit, okay? So, their justification for that statement is essentially down to this total return chart where they compare MPW on the one hand in the blue line to the S&P 500 in the gray, okay? So it stands to reason that if an individual stock has had their price absolutely hammered, all right, because individual stocks can be a lot more volatile than the underlying indexes unless they're maybe consumer staples, it stands to reason that this backtest is going to look really, really bad at the current point in time because the last few weeks have been utterly, utterly horrifying from a price perspective, right? A price performance perspective in terms of Medical Properties Trust. They've taken a nosedive, okay? No doubt about that. But this total return does take into account dividends, okay? So basically they're saying, hey, if we go back to 2013 and then run it to today, the S&P 500's done better. Because, the dividend's obviously only a component of your return, and then the price appreciation or depreciation is the other component, right? So the only problem is that if you were to have run this exact same scenario at a different point in time, you might reach a different conclusion, okay? So I noticed on this exact same chart, from 2013 to 2019, it would seem that at the point we were at in 2019, Medical Properties Trust actually was edging out the S&P 500, which made me think, well, what if we had run our 10-year backtest in 2019? What if this same author was looking at it at that point, okay? What conclusion would they have had to draw? Well, here's that chart for MPW, okay? Price performance wise, they went from a little over $3 a share to about $15.50 at the very, very tippy top here, okay? So on that basis, we would have to say, okay, about a 5x before dividends, which MPW has always had a pretty high yield, okay? So 5x return before dividends. What's SPY, okay? The ETF that tracks the S&P 500. What did they do in that same time frame, okay? Well, 80 something bucks to like 280, so 3.5-ish, X return on that ETF. So if you had bought at the same point in 2009, MPW and SPY, your MPW would have done substantially better, just in terms of price. But remember, this is before dividends. If you were to add dividends on top, MPW would absolutely choke slam SPY over this specific 10-year period. So just like 3.5 years ago, if you had run this exact same scenario that they did in that Motley Fool article, you would have had to reach the conclusion MPW's track record as an investment is absolutely stellar. It crushed the S&P 500 over the last 10 years. It's a buy all day long. Ooh. The only problem is that that type of a back test, or whatever you want to call it, would suggest that something is a good buy or like a good investment, has a good track record when it's at a high, okay? And, from 2019 onward, there were points where it got higher, low 20s, I believe. I think 22 maybe or something like that was where it topped out at one point. I mean, are we going to sit here and say that it's a better time? Like, it would have been smart to buy it? I mean, I just don't get how this is supposed to be useful when in 2019 we would have had to reach the opposite conclusion using the same logic, right? Now, my logic is that when a stock or any company, any investment has a decline in its price on the market that brings it below what I think its intrinsic value could be. Now, I don't think you can ever be 100% sure of the exact intrinsic value of a stock. Too many moving parts and too many X factors to kind of factor in. But by the metrics we can measure, right? It's trading below its equity on its balance sheet, and it's at a really, really low multiple of its funds from operations compared with its peers. Okay, those seem to be indicators of just straight up fundamental underpricing, right? A price value disconnect in the market, potentially. And so that's the basis on which I'm buying it. And I would guess that after 0809, when everybody hated MPW and it took an absolute beating, I'm guessing it probably would have made the same kind of sense by my logic back in 2009, okay? And we just happen to be at another point where share price has taken a beating. It's at a pretty substantial low compared to the recent past, and suddenly it looks fundamentally undervalued. So I would rather buy it when it's like $8, $9, $10 rather than when it's $15, $18, $20, $22. Okay, that's just me. But if you use the same logic as this, you would get to the opposite conclusion and buy here and then massively underperform the S&P 500. It's almost just silly on the face of it. And that's why I personally I take these articles with a grain of salt. I'll sometimes look at them just to see if they have any information that I'm not already aware of. But yeah, overall, definitely always take it with a grain of salt, and try not to be too salty though. All right, like, comment, subscribe, join the Discord in the description if you want to have conversations about this and other such fun things. Take it easy, and peace.